Okay, recording. Hello, everybody. My name is Dylan Bruce Limsam, majoring in quantitative finance and risk management science, and welcome to my CSCI 2730 presentation on smart contracts in banking and finance, enhancing efficiency, security, and transparency. Now, a quick introduction. As financial institutions navigate through an era of digital transformation, they face many challenges such as manual process inefficiency, fraud vulnerabilities, and increasing demands for transparency. Traditional banking systems, while reliable, often struggle with lengthy transaction times, high operational costs, and complex reconciliation processes. This is where blockchain technology, specifically smart contracts, offers transformative potential. Smart contracts, as seen later, are self-executing digital agreements that automate, verify, and enforce contractual terms without intermediaries. They operate on decentralized networks, combining the logic of software programming with the security of cryptographic protocols. In this presentation, I will guide you through my comprehensive research on how major financial institutions are implementing this technology today. In this presentation, I will be covering three key areas. First, I will explain how smart contracts work and why their characteristics of automation, transparency, and security make them suited for financial applications, which, if I go back to the table of contents, will be covered in section 2.1. Second, I will showcase real-world implementations across global banks, from Banco Santander's automated lending to Goldman Sachs' risk management systems, demonstrating tangible improvements in efficiency, cost reduction, and customer satisfaction, which is basically section 2.2 to 2.3 as covered here. And finally, I will be analyzing the significant challenges and future opportunities revealed by my research, from critical security vulnerabilities exemplified by the 2016 DAO hack and all sorts of other challenges as seen in section 3.2, and technological advancements such as new smart contract software such as Viper being developed, which is seen in section 3.3. And then finally, I will conclude my research, which basically states that smart contracts represent a pivotal innovation for banking, one that balances technological potential with practical implementation realities. They offer not just incremental improvements, but fundamentally new approaches to financial agreements, which could potentially reshape the industry's operational landscape. Now let's begin by understanding exactly what smart contracts are and why they matter in section 2.1. Now, like stated before, they're self-executing programs stored on a blockchain and automatically execute, verify, or enforce the terms of an agreement when their specific terms and conditions are met. From my research, I've seen basically that there are a lot of complexities to creating smart contracts, where there's, as seen through this diagram, there's negotiation of multiple parties, and they must be designed and implemented in a very specific way for security purposes. They're then deployed, freezing assets and storing them, and where the contracts are then stored on the blockchain, as seen through the blocks connected to the Genesis block right there, where this decentralized nature and connection on the blockchain helps to improve security and privacy of transactions through immutability and the whole decentralized nature, which also removes the need for intermediaries. Then, as we continue down for the smart contracts lifecycle, it is executed and where the contract is evaluated and automatically executed, and completion occurs where all the assets are unfrozen and distributed accordingly. Now, I've identified 4 defining characteristics that make smart contracts very valuable in terms of financial applications. First off, we have self-execution and efficiency. The fact that they operate autonomously allows them to automate a lot of processes and eliminate intermediaries, from payment processors, clearinghouses, or verification agents. This reduces processing time significantly and allows loan approvals to happen in real time, insurance claims that process automatically, and trade settlements that occur instantly when conditions are met, saving a lot of money through operational costs. Second, there is high transparency and immutability, since every transaction in contract state is recorded on the distributed ledger, visible to all authorized parties. Unlike traditional databases, which can be altered or accessed unevenly, blockchain has a single source of truth and can't be modified retroactively. This means complete audit trails, reduced reconciliation costs, and visibility into complex multi-party transactions, overall helping to benefit the legal landscape of finance. Finally, there is high security and privacy through cryptography, since smart contracts inherit blockchain security model and use cryptographic techniques that make transactions tamper-resistant. The combination of decentralization, since no single entity controls the network, and advanced encryption create systems that are significantly more resistant to fraud and unauthorized manipulation compared to centralized alternatives. Finally, we have a very useful aspect, which is customization and flexibility. Despite their automated nature, smart contracts can encode remarkably sophisticated business logic. They can handle multi-signature approvals or time-based triggers, and this allows financial institutions to digitize even their most intricate instruments, from structured derivatives to syndicated loans, while maintaining precise controls over their terms and execution. Now, moving on, I'll be covering how these smart contracts are actually implemented in the financial sector. My research reveals that adoption is occurring across two primary pathways: integrated solutions that enhance existing banking processes, and entirely new financial products which were previously impractical or impossible. Let's start with integrated solutions. These implementations focus on improving established banking operations through automation and increased transparency. I've covered many examples, from loans to improving customer experience and digital identities, so I will just be elaborating on more important some of the main examples that I've used throughout my research project. One compelling example comes from Banco Santander, which has implemented smart contracts for peer-to-peer lending platforms. Their system basically automates the entire loan life cycle, from credit scoring to identity verification to fund disbursement and repayment tracking. According to research by Su in 2021, this has reduced approval times by approximately 70%, while simultaneously lowering default rates through more sophisticated real-time risk assessment algorithms encoded directly into contract logic. In the insurance sector, Allianz, which is another bank, has pioneered automated claims processing through Internet of Things enabled smart contracts. There's basically sensors on all these insured assets like vehicles or property, which continuously monitor for damage indicators. When an incident occurs, sensor data automatically triggers a smart contract, which verifies coverage, calculates payout amounts based on predefined parameters, and initiates payment, all without human intervention, and basically saving up a lot of time and money on things that were originally week-long processes involving paperwork and manual verification. Finally, for institutional investment and risk management, which is 2.26, Goldman Sachs has deployed smart contract systems that provide real-time portfolio assessment and automated hedging. These contracts monitor market conditions against predefined risk thresholds and automatically execute derivative positions when certain volatility or correlation parameters are breached. What makes this revolutionary is the shift from periodic manual risk assessment, typically conducted daily or weekly, to continuous automated monitoring that can respond to market movements in milliseconds rather than hours or days. Much, much faster. A table demonstrating these use cases can be seen in the first appendix, which basically demonstrates all these use cases and their overall application and objective, and any challenges surrounding uh, the application of smart contracts in these areas. I've also referenced the appropriate papers that I got these applications from. Now, I'll be examining the second pathway, which is basically section 2.3. There's new financial products that are enabled by smart contracts. These represent not only improvements to existing services, but fundamentally new offerings. In this section, I will be covering some transaction management, crowdfunding, and even basically predictive markets. But the paper also covers other applications from asset management to derivatives management. So firstly, we have firms such as Citigroup, which has developed a cross-border payment system which bypasses traditional correspondent banking networks. Their smart contracts handle currency conversion, regulatory compliance checks across multiple jurisdictions, and automated settlement, reducing transaction costs by up to 80% and cutting settlement times from the typical 3 to 5 days down to mere hours, showing a significant increase in efficiency. Deutsche Bank, on the other hand, has also created a blockchain-based crowdfunding platform where smart contracts manage the entire investment life cycle. Investors' funds are held in contracts that release capital to projects only when predefined milestones are verified, and which obviously helps through transparency and security when tracking your funds in a crowdfunding project. Returns are automatically distributed according to complex waterfall structures that would be administratively burdensome to manage manually. And this creates unprecedented transparency. Being able to track their funds in real time just helps investors out a lot in knowing where their funds are and their satisfaction with these crowdfunding programs. And finally, most innovatively perhaps, is JP Morgan Chase experimenting with predictive markets built on smart contract infrastructure. These markets allow corporate clients to hedge against specific future events, from regulatory changes, commodity price fluctuations, or supply chain disruptions, by creating conditional contracts that automatically settle based on verifiable external data. This transforms risk management from a reactive to a proactive discipline, allowing firms to price and transfer risk for scenarios that were previously uninsurable or very expensive to hedge against. Once again, there is a table covering these use cases and any objectives and challenges surrounding them. Now, after talking about this section, I would just like to say what unites these diverse applications is their movement beyond pilot programs into production systems. They're delivering measurable business value. They aren't theoretical, and they're clearly operational, processing real transactions, managing actual risk, and serving genuine customers. The institutions implementing them report not only in efficiency gains and cost reductions, but new revenue streams, improved customer satisfaction metrics, and enhanced competitive positioning in increasingly digital financial markets. As such, we can see that smart contracts are providing a significant number of benefits. However, these promising applications exist alongside significant challenges and risks. The very features that make smart contracts powerful, from their autonomy to their immutability and complexity, create vulnerabilities that my research has examined in depth. To understand both the potential and the pitfalls of this technology, we need to examine a critical case study that exposed fundamental issues in smart contract security and governance. This brings us to the 2016 Decentralized Autonomous Organization Hack. This was an ambitious experiment, venture capital fund built entirely on smart contracts, operating without traditional management or human oversight. However, in June 2016, an attacker exploited a vulnerability in its code, draining approximately $60 million worth of Ethereum and exposing not just a technical flaw, but a lot of fundamental questions about smart contract security, governance, and implementation in regulated finance. So, if I try to explain this technical vulnerability, the flaw was basically a re-entrancy attack, where a sophisticated exploit where the attacker's code repeatedly called the DAO's withdrawal function within a single transaction. The smart contract had a critical sequencing error. It sent funds to the user before updating its internal accounting and allowed the attacker to create a loop where funds kept flowing out while the contract's ledger still showed the original balance. It was essentially a digital bank heist enabled by approximately 50 lines of flawed code, which, as when we check in the appendix, can be seen through this contract DAO. Sorry. This withdrawal function as seen in Solidity. Now, moving back to the overall philosophical challenges that stem from losing this absurd amount of money due to flawed code, we can see that this incident exposed the limitations of technical auditing. DAO's code had undergone multiple security reviews, but there was this critical vulnerability that was not seen until it was exploited. For banks managing in trillions in customer assets, that this shows that even an extensively reviewed smart contracts can contain catastrophic flaws, and that financial institutions cannot rely solely on code audits. They need more layered security approaches combining technical verification and procedural safeguards, insurance mechanisms, and ongoing monitoring. Secondly, the hack created the immutability dilemma, where the Ethereum community had faced an impossible choice, which was honoring the blockchain principle of code being law, or executing a hard fork and rewriting blockchain's history to recover the funds. The community decided to create a hard fork, and leading to Ethereum Classic as a splinter community. And this demonstrates that when stakes are sufficiently high enough, human governance inevitably takes place over automated systems. For regulated banks, this means that smart contract implementations must preserve mechanisms for human intervention, error correction, and dispute resolution, which makes things a lot more complex and technically more expensive and when implementing smart contracts, potentially undermining automation benefits. Finally, the incident reveals governance gaps in supposedly autonomous systems. When the contract failed, decision-making power didn't magically decentralize. It reverted back to centralized authorities, such as the Ethereum Foundation and major mining pools. This shows that the more critical the financial system is, the less comfortable we are with full automation. And my research suggests that a truly autonomous financial system is probably kind of difficult to implement, especially for high-stakes applications. Instead, more practical implementations will involve hybrid models where smart contracts handle routine operations while preserving human oversight for exceptions, disputes, and crisis situations. Now, beyond the specific case study, my research identifies 5 persistent, interconnected challenges that financial institutions must navigate even when implementing smart contracts. Firstly, there's the interoperability challenge, which affects integrated solutions, as we've discussed. Citigroup's cross-border payment system, for example, needs to interact with Deutsche as a hypothetical solution. If Citigroup's cross-border payment system needs to interact with Deutsche Bank's crowdfunding platform or Goldman Sachs risk management contracts, these systems may be built on different blockchain architectures that cannot communicate seamlessly. And this creates a lot of problems that smart contracts promise to eliminate. The trade finance smart contracts used by institutions like HSBC cannot easily share data with supply chain contracts used by their corporate clients, limiting efficiency gains. Next is security privacy tension, which affects banking applications specifically. The transparency that makes smart contracts valuable for audit trails and compliance, like in regulatory reporting systems used by Barclays, directly conflicts with banking privacy requirements. When UBS implements asset management smart contracts or Morgan Stanley creates wealth management automation, they must balance the blockchain's inherent transparency with client confidentiality obligations. The technical conflict has no simple solution within current smart contract architectures. Security and transparency. Now, moving on, there is a lot of complexity, scalability, and implementation costs. This may directly impact the return on investment calculations for projects that I've decided to examine. The specialized knowledge required to develop banking-grade smart contracts, combining financial instrument expertise with blockchain security knowledge, creates significant resource constraints. My research shows that development costs for sophisticated financial smart contracts can be 3 to 5 times higher than traditional fintech projects, which affects the business case for implementations like Deutsche Bank's crowdfunding platform or Citigroup's payment systems. Furthermore, blockchain-based systems also have to handle large volumes of transactions, which can cause significant scalability issues and limit their overall adoption for large financial institutions that need to process tens of thousands of transactions per second. Finally is regulation. There's a lot of regulatory uncertainty, which creates direct compliance risks for any implementations that I've reviewed. When JP Morgan Chase creates predictive markets or Allianz implements automated insurance claims, they're operating in multiple jurisdictions with differing approaches to smart contract legality. My research found that while Singapore recognizes smart contracts as legally binding, other jurisdictions are still developing frameworks. This means that the same automated loan contract that works seamlessly for Banco Santander in one country might not be enforceable in others, creating a lot of complexity for global banking operations, and further making it harder for some firms to adopt. There are also some consumer protection and anti-money laundering laws that impose restrictions on adopting contracts. Now, what's crucial to understand is that these challenges don't exist in isolation. They interact in complex ways. Regulatory uncertainty amplifies adoption resistance, scalability limitations, return on investment calculations. Security concerns, increased implementation complexity, and the interconnectedness means piecemeal solutions are insufficient. To address these challenges, we need holistic solutions that consider technical, regulatory, and organizational dimensions simultaneously. For financial institutions, these findings suggest that successful smart contract implementation will likely follow hybrid models that balance innovation with prudence, combining the efficiency of automation with the oversight of traditional finance. Recognizing that in high-stakes financial applications, perfect autonomy may not be achievable or be desirable. Now, I will be looking at the last section of my essay, which looks at the future outlooks and opportunities for smart contracts. Firstly, addressing the interoperability challenge, there's a lot of cross-chain communication protocols, such as blockchain bridges or relays, which are enabling smart contracts to communicate and exchange data across different networks seamlessly. For financial institutions, this means that the future could allow, for example, a trade finance contract on Hyperledger to automatically trigger a payment on Ethereum, or a loan contract on Corda to interact with collateral management system on a different network. This will gradually break down the current situation of incompatibilities on blockchain platforms and allow for efficient exchange of data for financial institutions. Now, secondly, the evolving security paradigms. Beyond reactive auditing, the security has begun to improve through formal verification methods, where smart contracts may go through formalities to ensure that valid contracts are being deployed. Advanced cryptographic technologies such as zero knowledge proofs and secure multi-party computations are also being developed to maintain integrity. And new programming languages like Viper are being designed specifically for a safer smart contract development. For banks, this means that future smart contracts could comply with strict privacy regulations like GDPR while still providing the benefits of transparency and auditability, previously difficult bounds to achieve. Third, scalability solutions are beginning to reach maturity, which is basically section 3.3. Layer 2 solutions like roll-ups and state channels are moving from research papers to production systems, and Ethereum's transition to proof of stake and implementation of sharding represent fundamental architectural improvements. While current systems only handle like dozens of transactions a second, these innovations point toward a future where thousands or even tens of thousands of transactions per second become feasible, approaching the output needed for mainstream banking applications. Now, fourth is regulatory frameworks were crystallizing. For example, the EU Markets in Crypto Assets Regulation represents one of the first comprehensive attempts to create legal clarity for blockchain-based financial instruments. Similarly, forward-thinking jurisdictions like Singapore and Switzerland are developing sandbox approaches that allow innovation while maintaining consumer protection. This regulatory evolution will gradually reduce compliance uncertainty and encourage more institutional adoption, helping out with problems such as the DAO attack in the future. And finally, to summarize, there's significant development of new products and services in terms of the blockchain, where, as I've covered earlier, we've had advancements in crowdfunding platforms, transaction management, and predictive markets. And these smart contracts facilitate novel business models such as decentralized autonomous organizations and offer developers opportunities to build applications and supply chain financing. And overall, their decentralized nature also helps to combat corruption and promote transparency regarding these new products and services. Now, after talking about these future opportunities, I've decided to give 4 practical recommendations regarding the adoption of smart contracts in finance. First off, we need to adopt a phased, use case driven approach where we start by basically with contained applications where smart contracts offer clear advantages with manageable risk, document verification, automated compliance reporting. And then by succeeding in these areas, we can build institutional knowledge and tackle more complex problems. Secondly, we should invest in cross-disciplinary teams, since successful implementations require combining financial expertise with technical knowledge. They should probably be integrated with business units and maintained using specialized technical support, ensuring that solutions address real business needs while maintaining technical robustness. Thirdly is design for hybrid governance. It should be acknowledged that fully autonomous systems would probably not be the best for high-stakes financial applications. We probably need to build in mechanisms for human oversight and to resolve disputes, and this balanced approach may sacrifice theoretical purity, but will likely lead to practical viability gains. And the fourth one is that we should engage proactively with regulators. Rather than viewing regulation as a constraint, we should help to shape emerging frameworks that support innovation and protect consumers to maintain financial stability. By working together with the government, we can help solve any of these regulatory problems earlier and ensure that we can reap the most out of the benefits of future developments in smart contracts. To conclude, my research demonstrates that smart contracts represent neither a revolutionary overthrow of traditional finance, nor merely incremental technological improvement. Instead, it's a fundamental reimagination of how financial agreements are structured, executed, and enforced. I think that smart contracts in banking embody a broader truth about technological transformation. The most impactful innovations are often those that augment and improve existing systems than replace them entirely. They offer a future where financial agreements are more efficient through automation, more trustworthy through transparency, and more innovative through programmability, but only if implemented with attention to security, governance, and real-world constraints. This balanced perspective represents the core contribution of my research. Thank you for your attention. This has been my presentation on smart contracts in banking and finance, enhancing efficiency, security, and transparency.